start from, first of all, before we go into calculation, we'll start from understanding different principles that relates to inventory. Okay, some of the principles you need to know here that relates to how we report inventory-related transactions on financial statements. There are 4 different principles that's newly introduced in this chapter. The first one here, consistency. So since we're talking about different inventory methods, consistency guides accountants for corporations to use the same type of inventory method along the years. So meaning once the business starts, once the business incorporates, if they decide, of course this usually is management level will decide together with accountants, if they decide to use one specific FIFO method, you can assume that it will be using the same method along the years unless they specify this, they disclose otherwise. Okay, so consistency, when you look at financial statements, if you don't see anything disclosed as related to they have changed the methods, you could be pretty confident that they're still using the same method as what they used before in prior years. Because under consistency principle, usually you'll be using the same method to evaluate inventory. And in Chapter 9, we'll talk about evaluating depreciation for long-term assets. They usually have to be using this. They have to use the same method along the years. Now, in some cases, business may decide, may have other plans. Strategically, they want to change a method to another one. Then they have to disclose this information, announce it in financial statements, basically. Okay, so the consistency principle guides accountants to use the same method, but in case management level decides to change the method that they think suits their business best in the next season, they'll be disclosing this information in footnote of financial statements. Okay, so disclosure guides accountants to report any information that would possibly change outside users' decision making. Okay, so reporting something that has changed, it could be inventory methods, it could be how companies depreciate long-term asset. So in Chapter 3, we talked about depreciation. That method actually is straight line depreciation along the years. Later on in Chapter 9, we'll introduce also different types of depreciation methods. If a company changes it, they have to disclose this information in financial statements. Okay, so disclosure concept, the core is that outside users, they need a full amount of information. So anything that has changed, that shifts, needs to be announced in financial statements. Okay, it may not necessarily be anything in a dollar amount, just a line under footnotes that they have changed from FIFO to LIFO, or LIFO to average costing, for example. Okay, but if that statement is not there, if the announcement is not there, then you can assume that they have been consistently using the same method compared as last year's, as prior years.